Hi, this is our last mini lecture for Chapter 1, and we will cover both Learning Outcomes 3 and 4. Learning Outcome 3 deals with how financial statements are used by decision makers. That's on page 7 of 8 in your chapter summary notes for Chapter 1, which remember you can find in the Chapter 1 folder in Blackboard. Now, if this issue of explaining how financial statements are used by decision makers sounds familiar, we actually talked about this a bit in our first mini lecture. We talked about how creditors, investors, directors of the company, and even government agencies need useful information to make decisions about companies. In financial accounting, we focus on the users outside of the business, or external users. And particularly that means creditors, who are people who the business already owes money to or is seeking credit or a loan from. And the other group is investors or potential investors, people who are trying to find out if the company is a good investment, or investors who are wondering if they will get a return on their investment. So let's review those uses. For creditors, they're mainly interested in assessing if the company is generating enough cash to pay what it already owes. So if they owe them money, they're going to be looking to see if they're in compliance with the loan agreement. And if the company is seeking a loan, they're going to look to see if the company has enough cash to pay what it owes other creditors. Creditors would be interested in seeing whether operating activities are producing positive cash flows. So they're looking to see whether they have enough assets to pay their liabilities, which they could find on the balance sheet, and they're also looking at the statement of cash flows. In number 2, well, that's exactly what I just said. Does the company have enough assets, economic resources, to cover or pay for its debts or liabilities? And that answer comes from the balance sheet. If we're looking at it from an investor perspective, investors, people who give the company money in exchange for common stock, they expect a return on their investment, on their contributions to the company. So their returns may come in one of two forms. It might be an immediate return because they're looking for dividends, which is a share of the company's profits or net income. We can see if a company gave dividends by looking at the statement of retained earnings. Long-term return on their investment could be that their stock increases in value over time. And maybe they decide to hold that stock just because they're looking for an increase in value so that over time, as it increases in value, their investment increases, and when they sell it, they could make a lot more money than what they paid for that investment. Okay, so let's take a look at Learning Outcome 1-4. And Learning Outcome 1-4 deals with describing factors that contribute to useful financial information. Again, let's think about the purpose of financial accounting. It seeks to provide useful information for individuals or companies who need to make decisions about companies. Primarily, we focus on creditors and investors. And we do that by analyzing, recording, and summarizing business activities in reports called financial statements. So, what exactly makes financial information useful? Well, one is consistency. All for-profit companies should be following the same rules so that you can compare them to one another. Can you imagine trying to compare two football teams if one used a field of 200 yards and another a field of 100 yards? Or if one used 15 yards for a first down and the other used only 5 yards for a first down? Then we couldn't compare teams, right? How would we know who to pick for our fantasy football teams? Well, joking aside, we need a set of rules that all for-profit companies will follow. And the rules for how we record and report financial information are called generally accepted accounting principles. I often refer to those as GAAP because that's what it kind of looks like. These are the rules and guidelines of accounting created by the FASB. The FASB is the Financial Accounting Standards Board, and they have the primary responsibility for setting those rules. Now, if a company, a corporation stock is traded, then primarily it's the SEC who is responsible, but they defer their authority to the Financial Accounting Standards Board, and they are an independent group. They're made out of a lot of different folks who are accountants, who are educators, who are business people, who are economists, and they're the ones who set the rules for how we record and report things, which is what we will be learning in this semester. Now, believe it or not, all countries have their own version of the rules. They have their own gaps, so to speak, and they don't all match. If you look at a balance sheet from Great Britain or China, it would look different than the balance sheet from the US. And the rules about recording and reporting would be different too. Well, that causes a problem when an investor wants to choose the best company to invest in, and he or she can't compare companies because they calculate net income differently. So, an organization called the International Accounting Standards Board was organized with representatives from all over the world, and it's their job to develop a set of rules that everyone could agree with. Well, the U.S. hasn't signed on to those rules yet, but a number of U.S. companies have already begun to follow them because we're pretty close, and they have decided to produce a second set of financial statements based on the rules that the IASB has developed, and those rules are called the International Financial Reporting Standards. So the U.S. rules are called Generally Accepted Accounting Principles, and the international rules are called the International Financial Reporting Standards. And the reason why a number of those companies have decided to produce a second set of financial statements is they want to compete for investment dollars with companies from all over the world. Okay, now what you're learning this semester, you're learning GAAP, the Generally Accepted Accounting Principles that we use in the U.S., and for the most part, the rules that you're learning are exactly the same as the International Financial Reporting Standards. There will be a few cases where they will differ, and when that happens, I will definitely let you know about it. Okay, so it says here that the main goal of GAAP and IFRS is to ensure companies produce financial information that is useful to existing and potential investors and creditors in making decisions. So what exactly makes information useful? Well, there's two fundamental characteristics, and one is relevance. The information is relevant if it makes a difference in our decision making. And the second characteristic is that it is a faithful representation if it fully depicts the economic substance of business activities. Now I'm going to switch for a moment to a graphic. It's going to have the same information on there, but it portrays it in a little more interesting format. So there's the objective, to produce useful financial information to our external users, both potential and existing investors, and potential and existing creditors, which would be our suppliers and people who loan the company money. And we said what makes the information useful is that it is both relevant and a faithful representation of the business activity. Now, these are characteristics of relevance and faithful representation. A financial report is relevant if it's timely, if it's available in time to influence decision makers, if the information is current. If, for example, a company went to a bank for a loan And the bank asked that company for a balance sheet and an income statement, and that company gave the bank a balance sheet and income statement that was 5 years old. The bank would reject the loan application because they didn't give them timely information, more current information. Financial reports are useful if they're verifiable, if there's proof that a transaction occurred, and if others, such as external auditors. Auditors are the folks who come in and check to make sure the company is using generally accepted accounting principles in their accounting systems. If those external auditors can reach similar values using similar methods. Information is useful if it's comparable. If the company is using the same accounting principles and procedures from period to period to period. Because you'll learn this semester that when a company changes its accounting policies, it may cause different results in the net income or on their other financial statements. Well, in that case, a reader of a financial statement wouldn't know whether the company was making more or less income because they were more or less successful or because they changed their accounting procedures. We also want to make sure that they're comparable in the respect that they're following generally accepted accounting principles so that we can compare company to company because they're using the same rules. And then finally, information is useful if we can understand it. If reasonably informed users can understand, comprehend, that means, and interpret the information. Okay, so who's responsible for ensuring that companies follow generally accepted accounting principles? Well, believe it or not, it's primarily the managers, not necessarily the accountants first. It's the CEO, it's the board of directors, and yes, the CFO as well, but primarily the managers. And if the business is a publicly traded corporation, which means that they've decided to sell their stock on the public exchanges, then remember they're responsible for following all the laws and rules established by the Securities and Exchange Commission. And one of those rules is that they have to hire independent auditors to scrutinize their financial statements and then issue a report as to whether or not they're following generally accepted accounting principles. Now, private companies don't have to do this because they're responsible to their investors or those investors who have contributed money in exchange for stock, and it's a small group usually. They're closely held shares of stock. And if the investors insisted upon it, or if the creditors of the company insisted upon it, then the company would get an audit. But it isn't required by anyone, by law. The other thing we have to think about is because we're responsible to the SEC if we are a publicly traded company, then we have certain other rules called the Sarbanes-Oxley Act. This act was passed in response to the many reporting scandals that occurred in the early 2000s. Now, you're fairly young, so you might not remember those, but we had Enron, MCI WorldCom, HealthSouth, Parmalat, Tyco, and closer to home we had Adelphia. And they all fraudulently reported their financial position on their financial statements. So now the Sarbanes-Oxley Act requires that those leading the company sign a report certifying that, yes, they have primary responsibility for the financial statements, and those financial statements follow generally accepted accounting principles. And if they don't, those folks can serve up to 20 years in prison. Because by issuing fraudulent financial statements that companies or individuals rely on and perhaps invest in the company or loan the company money, if they lose their money, then it's those leaders, those managers of those companies that are responsible. Now, the Sarbanes-Oxley Act also requires a company to maintain a system of internal controls that auditors also come in and check. And these are a set of policies and procedures to encourage accuracy in the accounting reports and to safeguard assets, among other things. And they also have to have an independent audit committee that works along with the auditors to ensure that a good audit occurs. Now, the Sarbanes-Oxley Act, we said, was passed in response to all of those scandals. And that comes back to the importance of ethical conduct. The standards of conduct for judging right from wrong, honest from dishonest, fair from unfair. And especially for accountants, your reputation hinges on your ethical conduct, because no one wants to hire an accountant that they can't trust to be honest and fair and follow the rules. But the same goes for any other business person, correct? We want to make sure that the people that we employ are not going to embezzle money from us or misrepresent us on a set of financial statements. So it says here, when you're faced with an ethical dilemma, you should follow a 3-step process. Identify who will be affected by the situation, those that will benefit and those that will be harmed. Identify and evaluate alternative courses of action, and then choose the alternative that is most ethical. And I've heard it referred to as the tombstone test. Would you want this act displayed on your tombstone as saying that was what you were remembered for? Or would you mind if your grandmother saw a story about you committing that act on television or read it in the paper? That should be one measure, or could be one measure, of whether you should engage in that activity. Well, we are at the end of Chapter 1, so we're done with this mini lecture, and there are no more problem demonstrations. So if you haven't yet done your homework problems, you can go on to those now, and I hope you have a great night.